Hello, and welcome to our first quarter strategy review, believe it or not, for the next year, 2024. We met December 11th via Zoom. We had a guest, as usual, who had met with us before, and he was very helpful in getting all of the things that we were interested in. But he is Carlin Patel. He's with State Street Advisors, and we use many of their ETFs, and we were able to get a lot of information on that. Also with us was Len Skeena, Vice President and CEO of the firm, Bob Toomey, Vice President, Director of Research, and also joining us was Scott Schill, who is the Director of Longevity Planning, our new effort towards working with clients on their legal matters. At any rate, the meeting itself went rather long, actually. Carlin kept commenting, "We're running over time. Is that okay?" And we kept saying, "Yes, that's okay," because we're getting a lot of very, very useful information, which we will now impart to you. And let me segue over to Bob to talk about U.S. markets.
Thanks a lot, Stan, and happy holidays to everyone out there. So I think we came away from the meeting, as Stan mentioned, we had a really good session with Carlin, who joined us from State Street Research. I'd say in general, the members of the committee came away feeling generally positive about both the stock and bond markets. I think that with respect to the stock market, if we look at some of the factors that are important there, you're looking at the economy. We do see the economy holding up relatively well as we look into the first half of 2024. Inflation appears to be moderating, and we think that this is beneficial with regard to interest rates and also Federal Reserve policy. The Federal Reserve does have a meeting this week in which they will again address interest rates and deliberate whether or not we're going to see another hike in rates. We don't think we're going to see a hike in rates this month, and we think the Fed is pretty much at or near the end of their rate hiking cycle, which we also felt at the end of last quarter's meeting, and we think that is proving out to be the case. I think the other positive for U.S. equities is really corporate profits, which we believe are bottoming. Third quarter corporate profits grew 3% year over year, which was the first year over year increase in corporate profits in 4 quarters. And we think that's going to continue into 2024. And we believe that will be supportive of the stock market and be positive for stocks, which we continue to see rising from this point and looking into the first part of 2024. We believe that rising corporate profits will support stock valuations. And I think that there are other factors such as artificial intelligence and fiscal stimulus from programs that have been enacted by the federal government over the last couple of years. A lot of that stimulus still has to flow through to the economy. So all of these things we think are supporting a positive economy and earnings environment, which sets a positive backdrop for U.S. stocks. With that, I will turn it over to Len, who's going to talk about international equities.
Thank you, Bob. We continue to underweight international equities relative to the U.S., as economic performance in the non-U.S. developed markets has lagged that of ours. In addition, China reopening post their COVID shutdown has been underwhelming, which leads us to continue to eschew the emerging markets, which tend to be more dependent on a strong Chinese economy. So we're going to continue, as we have for several quarters now, to emphasize U.S. equities more than international. With that, Stan will now talk about REITs.
Thanks, Len. Yeah, REITs, of course, have been a stalwart in our portfolio for really a long period of time. but they have not really been performing as well as we would like. And yet they have a very high rate of return because we do get a pass through on the dividends, and we certainly like to maintain that. Jumping the gun just a little bit, though, we are looking for rates really possibly topping out or even coming down. That would be a positive for REITs. So that definitely gave us encouragement to continue our REIT investment, and we did pretty much at the same level. However, we did get some interesting information, and again, our guest Carlin talked and made a very strong case for home builders, and home builders are not truly REITs, but on the other hand, they are involved in the housing market. The view is that many people at this juncture still have a pent-up demand for housing and for building. But on the other hand, a lot of people don't want to sell their current housing because they don't want to give up the low interest rates they have. So the structure for home builders seems to be a little bit, maybe a lot better than we had thought about. So you will notice that we are actually adding some home builder equities into our REIT sleeve. And with that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. The Fed has been raising interest rates aggressively in 2023. We believe that they are likely near the end of the cycle of raising. We don't see them being in any hurry to lower rates, as they want to make sure that inflation remains under control, and they'll be watching that closely. The Fed's hands could ultimately be forced should a recession occur, but at this point, we don't really expect any recession to be severe. It would probably be relatively mild should it actually even count as a recession, and most likely will just be some kind of a mild slowdown. At this point, we anticipate rates staying elevated for a while, and we've mostly maintained our bond position. We are not changing our bond holdings, but we have decreased our allocation slightly in the intermediate and longer parts of the curve. Now, Bob will talk about changes in our model.
Thank you very much, Len. So Stan and Len have given us a pretty good overview of changes in fixed income and the REIT area. We did not make significant changes outside of that. I think our feeling has been staying the course. We feel that we have been positive on the stock market, really going back to October of 22. And we've been using these holdings that we have been using, we feel are appropriate, still appropriate at this point. I will comment on them briefly because that's what that's what research people do. Let's comment on some of these holdings that I think you should know about. And within the large cap area, we still own the Pacer free cash flow, large cap free cash flow companies ETF called COWZ, COWZ. We like that because it gives us not only steady dividends, but also these represent some of the highest quality companies in the S&P 500, and we feel that it's important to have exposure right now to quality companies. In the small cap area, we have an adjunct holding. Is the Avantis small cap value ETF, and we like that a lot because it's focused on companies with very high profitability. And we think within the small cap area, it's important to be overweighted to some degree to companies that are generating profits and free cash flow, largely because within the Russell 2000 index, a large portion of those companies do not actually earn money. So we think in this environment, AVUV gives us some good exposure to profitable companies in the small cap area. Within international, we have a holding, the Vanguard High Yield International Dividend Stock ETF that's enhancing income in that area, and we think is an important holding that gives us some, broadening our exposure in the international area. And then in energy, we continue to maintain our position in the XLE, which is the energy ETF, largely because we think that oil prices are, in most cases, probably bottoming at this point, and we think that we still want to have exposure to that area as a result of long-term supply constraints in oil and energy. So with that, I will turn it back over to Stan for closing comments.
Thanks, Bob. I'd like to just cover that we did at this meeting cover a lot of territory. And as you can see, we really remained in a relatively similar position, which has actually been serving us very well over the past couple of quarters. However, we are concerned about the Fed. We are concerned potentially about inflation. And we did set triggers relative to inflation. On the positive side, we said that if inflation basically goes below 2.75, we would consider that a positive trigger, and we would go back and revisit possibly increasing even more of our equity holdings. On the other hand, we are concerned because the Fed looks at it as a negative if inflation did go up over 1% on a monthly basis. We would consider that a negative trigger, and we might move towards reducing some of our exposure. So again, inflation, interest rates are the big driving factors that we see right now. And that's what we are addressing ourselves to over this period of time. In the meantime, I did go back and look and find that we are actually in our 11th year of doing these reviews for you. And I would like to point out that those are all on our website, and we are actually proud to have them out there. Not saying that we were right all the time, because we weren't, but on the other hand, please feel comfortable to go out and take a look at that. Have a happy holiday season, and we look forward to you joining us next quarter.